So today we are discussing the part 6. Under part 6, the business vehicle. The last session we stopped here, and now we are starting from here, the business vehicle. We are discussing the business vehicle for just for our understanding. We most of living people in UAE, and we having the some vehicle that we are using as a mode of transport. Mode of transport, we are traveling from one place to another place, and commonly we are going to our office and office to home and some other client meeting or some other purpose also. So our objective to the mobility that give us the option or the flexibility, we can move from one place to another place, from home to office or office to home, or to visit the client. So this is our objective. So our objective will remain same, but vehicle can be changed. Vehicle can, because maybe some people have the sedan and some people have the 4x4 or the station car. There's a many station cars. So maybe they are using that, or some people using the big vehicle there where the family members are more. So he needs the big vehicle to cover the objective of his family member. So by having the objective, we can take the calls. So which vehicle is suitable for us? So the concept is shared over here just for understanding from our practical example, our real life example. Now, if you apply the same example, understand why the business have different vehicle. Okay, so here the important part we are going to discuss what are the business vehicle and what are the plus and minus of having the vehicle. Because if the ownership or management or the shareholders, they must define their objective before starting the business. Accordingly, they will choose the vehicle, which vehicle mode is relevant for them. So for business vehicle, we will separate into two categories for our understanding, and this is the FTA also give in the same two category, the understanding or the clarification. Now on the same parameter we are going to discuss. So most of my understanding are the point of view to share with you guys as a part of tech series. I'm trying the way how I learned from the PwC. I am took the training from the PwC, so I'm keep aligning the way of sharing the knowledge with you guys, are trying to share the taxation training in the same pattern wherever is possible, but it's not the 100% is same, but the mode of the way of presentation and way of communicating, I'm trying to be keep the same. I'm trying make the presentation from different source of data wherever is possible. From mostly I tried from the FTA, like the workshops and the tax return that you will see today. The tax returns, couple of slides are there. So that I added over here for better understanding why we need this. I appreciate people do not make right on the slides. I appreciate your support in this regard. Now, our first vehicle. Our first vehicle is an unincorporated business. The unincorporated business, the category of unincorporated business, normally we understand the sole establishment. The sole establishment. What is the sole establishment? If the natural person or own the proper any company under his own name, is a one owner of the company, and there is no memorandum of article, there is no because that company is not established as per the company law. The company law, UAE commercial company law, that is latest is the June 2022. All the previous legislation and the latest one is this applicable, all the revision on the company law. The entity are registered, maybe the based on the previous version or based on the new version, so all the applicable legislation will be there. So if they registered the company under company law as that will fall under the juridical person. But if they are not registered under the company law, Because if you register under company law, you must have the memorandum of association, a memorandum of article, and mostly we see in one document, memorandum of association, a memorandum of article. But actually, this is a two document, but practically mostly they combine and issue only one document. Now, this is not the LLC. This is not the juridical person. So this is the unincorporated business. Why we are saying unincorporated? Because this is not registered as per the company law. Just for a better understanding, we discuss in a way to this is unincorporated means the business, the company or the owner have the trade license, but not under the company law, not under the company law applicable per VMs. So this is the point where we call such business operator as a unincorporated business. Let's move to the next point that we will understand over here. So what is the first form of the unincorporated business? That it is sole establishment. This is what I am discussing, the sole establishment. This is the most of the common form, and most of us, we are seeing the sole establishment. Second is the partnership. Now, mostly during this initial registration phase of the corporate tax, we are receiving the many queries from the clients as well as from our same fellows who are working in the market as a consultant, and the other in other groups of the corporate tax. There are many groups of most of the self-initiative. They made the groups. So they are raising the query, what is the sole establishment? And sole establishment that people normally assume this is only one person owned by company, but where the two person are coming, there is the two partners are coming under the same format. They think under which category they will fall, and most of them people take this partnership also under a juridical person. This is the common misunderstanding, and this is the mostly in this SME sector, because most of people are not well aware about the company law. So there is a many mistake is done. Initially, the FTA approved, but later on, FTA come to notice and they start rejecting that also, and they are redirecting to the correct registration. Now here the first difference that we're gonna understand. Under the unincorporated business, maybe sole establishment, maybe partnership, both are the same category. Salaries and wages of the owners 100% disallowed. If the person from his own business is taking the salaries, wages, allowance in terms of education, in terms of transport, or what format he will take these benefits, this is 100% disallowed. 100% disallowed. When we say that disallowed, you cannot deduct from the taxable income. There is a difference between taxable income and the accounting income. Mostly we, as of today, before the corporate tax, we are doing the accounting income. The profit and loss we are preparing based on the accounting income, not based on the taxable income. So there is a difference. Because what is the difference? Because in taxable income, this expense you can deduct, but in the taxable income, to calculate the tax liability, you cannot deduct. So even whatever the amount of the salaries and wages under the unincorporated business, you add it into the business, that will be not deductible. So here the point we are discussing the business income. So hope on this point is very much clear for you guys. Let's move to the now. Okay, now we already understand the non-deductible from the income as just the same non-deductible from the taxable income as expense. Under accounting you can deduct, but under taxable income you cannot deduct. If you already deduct from the accounting income, while calculating from the taxable income, you have to add back. So now who will pay the tax? Who will pay the corporate tax? Okay, in a whole discussion, we will maybe use the word tax or the corporate tax, but there is no income tax. just for our understanding, even the natural person is paying or the unincorporated business paying, they will pay the corporate tax only, not the income tax. The business, such business are the transparent, because in LLC, the LLC is a legal person, so that is a standalone company in the eyes of the law. But in the sole establishment, the business, under whatever the name they are operating, it will be transparent, because the business do not pay the tax. Who will pay? Partners are the sole proprietor of that business. They will pay tax. They will pay tax, and while calculating the, and they will pay. Here the another important part, because if the one natural person having the 5 sole establishments are having the 3 sole establishment and 2 partnership in the sole establishment with another company, so they have to calculate their under their name by calculating the income from the 5 establishment, and taking their, if they are part of any partnership, they have to take the relevant share, and they have to prepare the taxable income. The first part, they will take the accounting profit all from all the establishment. Then they will, I will use the word consolidate for our better understanding, because most of our working in the profession, we understand this all consolidate. I'm trying to explain here that if one natural person have the 5 sole establishment, so he have to consolidate the revenue and expenses of all this whole establishment, and make as a consolidated income and the expenses for the taxable purpose. So even from all the business, salaries and wages will disallowed. And if he's a part of any partnership, he have to take, if he's a 50% partner in any partnership, so he have to take the relevant share, that is a 50% from that business, and consolidate into one. Here the business will not pay the tax. Here the partners are the sole proprietor, they will pay the tax. As earlier I mentioned, UAE, we do not have the income tax, we have the corporate tax. So the individual who's running the business via trade license are required to take trade license located in some, engage in some activity, or running any business in the UAE. So they have to pay the corporate tax on that. Even the activities you are doing that required to have the trade license, just in the previous example, we understand they are subject to corporate tax. Now the second category, or the second type, or the second vehicle that we are going to discuss, that is the incorporated business. When we say the incorporated business, so again the same point that we discussed over there, salaries and wages, that is a disallowed, and here will be allowed, but still some terms and conditions are there. What are the terms and conditions that we will have to understand? Even during the last session, we seen the some of the question. How about the salaries and wages in the businesses? And unincorporated business we discussed is disallowed, but in incorporated business, juridical person is allowed. But here the still arm length. What is the arm length? For the employees, 100% will be deductible. But for the owners, shareholder, directors, or their family members, the word connected person is important, because if the owner or the CFO of the company, or shareholders of the company, or the director of the company, they are all the connected person. This is just understanding purpose, but we will discuss in detail what are the connected person, because connected person, but blood relation, it will go up 4th degree. 4th degree up, 4th degree down, 4th degree left, 4th degree right, because the circle they draw up to 4th degree. We will discuss in detail what are the connected person. So they are saying if shareholder, he make the employee his wife, his kids, his another relative in the company, and he just want to pay them higher salaries, so and reduce the tax base. To reduce the tax base, they will engage, even they are not working, and even they are just part of the their family member, but to reduce the tax base, they will put on the payroll. So FTA is saying if while doing the FTA audit, so they will ask this detail, and they think such you can engage them, but you will pay all this benefit on at the arm length. What is the arm length? Arm length means if in the market, other companies paying this salaries to their CFO or their manager or their HR manager in whatever the format. So you are engaging your connected person in that position. So we have to see what are the market standard. Now the market standard, there is no definite rule. We have to consider, okay, what is the company revenue, according to revenue, how much they can afford, and according to capability, according to skill set of the person. So they will consider a lot of factors. They will do their own exercise, and then they will give their comment on that. And if you are exceeding, they may charge penalty, or they will just say if the minor difference, they will give you some comment and move forward. But try to reconsider this, do the exercise, and how it will be important for the corporate tax return preparation and submission. Mostly we are receiving the comment, okay, we can increase their salary, our shareholders, their family members who are working, we will manage that. No, this is not blindly you can increase. You have to make the market analysis and remain in the arm length. So what are the incorporated business? There is a private companies, private limited companies, limited liability companies, public joint stock companies, incorporated companies, LLP. See, this part is the most important for our understanding. This part is limited liability partnership. Here is the partnership. Because a partnership, there is a no contract or the verbal contract. If you establish the partnership based on the verbal contract, you can do that. This is not required, or you may make the contract and notarize just for your own record, in which you put some, the profit distribution, working distribution, your working arrangement. But here, if you limited liability partnership, if you limit the liability of the partners by putting some capital, and you say, okay, the liability of the partners is limited, then that partnership business will fall under the incorporated business. Single person companies, here saying sole establishment, but under unincorporated business. But here saying single person company, sole proprietor, but this company, the word LLC will be there. Another point for a common understanding, memorandum of association will be there for such companies wherever the memorandum of association, because that for your understanding, company will be registered as per company law. Please go when tomorrow when you go to office, see your company trade license. What is the legal type? What is the legal type? So mostly that legal type will give you the understanding. Plus, you have to see, okay, this company have the memorandum of association or no. Let's move to the next point. Now here the business will pay the tax. Here the owner will pay the tax. Under unincorporated business, what we are saying, the partners are the owner of the company, they will pay. Business will not pay. Here we are saying business will pay the tax. The business will pay tax. Now here the transfer pricing rule will be applicable. Transfer pricing rule, why? Because maybe the same owner, he have multiple companies. Maybe UE, inside UE, outside UE. So again, they might transfer the higher company profit to another company outside country. So where the jurisdiction is a lower tax, or they are doing how they do, they will do the transaction through the price adjusting or whatever the means. We will discuss in detail the transfer pricing concept, how it will work. So what are the transfer pricing method, and how you can review on that, and how you will prepare the master file and local file. But here we understanding the overall concept. So transfer pricing, when you are part of the group of the same ownership, same ownership in terms of even the incorporated or even the shareholding. So we have to review the transfer pricing rule also. Okay, now here we discuss again, I'm just adding the points for the information note. What are the information note? Information note, if you have the local dividend, that will be exempt. Because from the local dividend you receive from another company, that company already paid, and then you receive the dividend. So you will not deduct as a expense from your income, or you will not add as part of your income, because the party who give you dividend is already deducted and paid the tax. Now here, just for understanding, we are putting the non-deductible, we might say as a haram income or haram expenses. In Arabic language, the word mostly we are using. On the other side, if it's allowed, we can say the halal expenses or halal income. Here, the another part I just, because such information we added to enhance the vision, for our better understanding, to improve the understanding. As of today, we are building our understanding towards the corporate tax. In the UK, the companies are they are prepared. In UK, even the natural person, they are paying the income tax. Even they are running the business under the same format what we are discussing as the unincorporated business, they are paying the income tax. Why we added this example? To have the better understanding. They are paying the income tax, but in UAE, we will pay the corporate tax. Why? Because they think in UAE, we do not have the income tax. So here the FTA, Ministry of Finance, they said the business activities, the more juridical person or business activities, if you earn the income from the business, then you have to pay the corporate tax. We will not pay the income tax, but in UK or the other jurisdiction, the natural person, they are paying the income tax. In UAE, there is no income tax, but currently in Oman, they are already applied or about to apply, implement the income tax also. In all the Gulf countries, I believe this Oman is the first GCC country who is applying the income tax, but they are not applying on all the person. They are applying on the high income, high salary people, or the person whose income is a high level. So they have some threshold. They are applying on that. Here, in UK, the income tax on the personnel or the natural person is a 45%. If there is a different threshold, if you exceed, it will go to 45%. But in companies, the corporate tax is a 9%. So of course, the people mostly will make their companies to adjust the corporate tax liability within the means of the applicable rules and regulation. So this is the one of the understanding and one of the reference I'm sharing here. In UK, they established the LLC companies instead of operating under their name. If mostly we are professional, we have the relative friends in the Europe or other part of the world, so they are mostly establishing the companies to run their business because they will have the many benefits over there.